to jump here just for a moment, electing the section 179. So vehicles, okay, vehicles, cars, trucks, I don't know, automobiles, however you want me to word that. These are going to be mostly subject to 179 depreciation rules because these are listed assets unless they're used for business 100%. Very important thing. When does depreciation begin and end? Well, it begins with either when you have purchased an asset or when you have placed it in service, whichever happened later. Okay, whichever happened later. So very simple. Whenever the client is asking you a question, oh, I put the property on the market to rent, but I didn't get a renter yet. Can I depreciate that rental? The answer should be absolutely yes. Was it placed in service? Did the client move out? Placed in service means not just that the renter moved in, but was it ready for the renter move in? Were there other people living in that property? Was it actually somewhere posted on the market, or something like that? And if the answer is yes, if it is a move-in ready, if it's on the market, it's simply business conditions were adverse and that's why renter hasn't moved in yet. Well, it's not or the rentee has not moved in yet. It's not the rentor's problem, okay? The business has started. They have done everything necessary, ordinary, and what they must have done to start that business. So the business has started, the property's on the market, and let's say they listed it to be on the market, to be rented, I don't know, December 1st. Boom, then that's when they should start depreciating that property, okay? What is the basis of your depreciable property? How we determine that? Well, that includes, frankly speaking, multitude of things, and I would strongly suggest for you guys to read through this for the, what the bases are. But mostly, it's anything and everything that is needed in order to place that property in service, so to speak, okay? If you bought the computer and you're like me, you got no idea how to hook it up, and you need to call a person to connect the monitor to the tower, which thankfully that I can do, and let's say set up the proper software and whatnot, then all of that is going, and let's say there was a delivery fee, all of that is going to go into the basis. When folks are purchasing a rental property, they sometimes do pay transfer fees, title fees, commissions to the real estate agent, whole bunch of things that go into that, and so that would all increase the basis of the property. So you sum it all up because that's what it took to place that property in service. Whether it's a machinery, whether it's equipment, whether it's a computer, whether it's an orchard where the trees need to be planted, where are the trees going to be productive if they're in the nursery pots? No. So was there labor involved to get the tree from the nursery pot into the ground in order for it to become an orchard? Yes. So whatever the balance sheet item, so to speak, is going to be, that fixed asset, it's whatever it took to place it in service. Does that make sense?
Yeah.
Mm-hmm.
Yeah.
Okay. Major one, how do you treat repairs and improvements? Well, totally separately, just like we talked, okay? Repair is an expense. It shows up on profit and loss statement, and it directly, by the nature of it, reduces net income. Improvements, however, are depreciated, meaning improvements are also fixed assets they show up as a separate line item, and improvements are sometimes as long-lived as the assets that were improved, or sometimes they have a lesser life than the asset itself to which the improvements were done. I think we do have a recording somewhere on what the improvements are. Sometimes it's not a clear-cut line, so there are a few questions that you need to ask yourself. Whether it returns property to original condition. If the answer is yes, it's an improvement. Does the, so to speak, repair, is it major in a sense where if it has not been done, the assets would no longer, so to speak, exist. You wouldn't be able to use it anymore. And in that case, if it's substantial enough, okay, then it's an improvement. And of course, if it ameliorates the condition, which Patrick can tell you guys later what the heck that means, then it's an improvement, okay? Do you have to file Form 4562? Yes, absolutely. And I do suggest that each and every one of you pull that form up once we're done with this training and look over it. It's very simple. What it does, it summarizes what is subject to 179 depreciation, whether we've taken it, what is subject to bonus depreciation and whether we have taken it, and you disclose how many fixed assets were specifically placed in service in the current year, and they're sorted by their class life. Okay, they're sorted by their class life, and it shows the total for each type and kind of depreciation expense we're taking. How do you correct depreciation deductions? Well, you would submit Form 3115. We will chat about that form later on when we're doing training on that, okay? Section 179, well, it's a fun one, and it varies, and yes, you must recapture the deduction upon sale. One thing that I need you to kind of think of is if you have received tax benefit for the property that you use for business, it means that you have been taking that depreciation expense. Once you're depreciating that asset, technically speaking, over time, it loses more and more and more value. So whatever you resell it for, sometimes what you need to do is recapture some of that depreciation that you've taken. Because let's say we have stipulated that a rental property is going to lose its value over 27.5 years. And let's say it has been 27.5 years, but then the person wants to sell it and now not only didn't lose in value, the person's actually selling it for double. So what happens then is you would show, and this is definitely, not, you can see it's only one page that talks about it, and it's definitely a longer topic than that. But you would need to show that depreciation that you've taken is now income to you because you've recouped it by selling the property. And then you also have the risk of the gain, let's say, just simply because the property appreciated, okay? I'll show you examples, but yes, you must. So you must recapture depreciation deduction if you sell the asset for over the original value, provided it has been fully depreciated. If not, we need to calculate how much actually has been depreciated and whether the gain is higher than the depreciation taken. And if the gain is higher than depreciation taken on that asset, we need to recapture depreciation expense. The problem with that is whenever we sell assets, okay, most of it is going to go on Form 4797, and hopefully there's going to be no recapture, and it's going to be long-term capital gains. If there is a recapture, it becomes Section 1231 item, and it's deemed to be ordinary income, which is absolutely horrible. Because ordinary income is taxed at marginal tax rates that go up to 37% federally, whereas long-term capital gains, they get preferential treatment of up to 20%. I know that it was packed just right now, but does that make sense?
Yep. Yeah. Everything's good.
Okay. Claiming the special depreciation allowance. What is a qualified property? Well, as of where it stands right now, okay, as of where it stands right now, it's property that has lived 15 years or less. 15 years or less, okay? And special depreciation allowance is interchangeable with bonus depreciation, okay? How much can you deduct? Well, that's going to vary on what kind of laws are being passed and whether they're extended, amended, retroactively amended, or, rewritten altogether. Where we're standing right now for 2023 bonus depreciation is 80 whopping percent from the value. In 2022, it was 100. So huge. It technically means that you have determined that the asset needs to be depreciated, let's say, over 7 years. The asset is $5,000. You know that it's not a repair. Let's say it's an improvement. Not sure why it would be 7 years, but whatever. Let's say that type of improvement specifically depreciated over 7 years. Instead of taking the, either double decline in balance or straight line depreciation, which inevitably, let's say the person wants to spread it out evenly, they're going to take from $1,000, that's not from, let's just say 7,000, $1,000 a year. So from 7,000 depreciated over 7 years, they would be taking $1,000 a year. But with the bonus depreciation for 2022, even though it didn't show up on the P&L as an expense and it didn't say repair right away, reducing, the sales, and of course, wiping out that portion of net income, so it goes lower right away. It showed up on the balance sheet as a fixed asset, but then we booked depreciation expense for the same amount. So bonus depreciation is huge, you guys. If folks are, let's say, barely making it, the business is barely making it cash flow wise, taking that depreciation in that first year, lowering net income or securing these losses moving forward, because let's say maybe they have $1 million worth of loss. Well, they cannot take the full thing on their tax return anyway, and if it's a C corp, then every single dollar that is a loss will be carrying forward. So at that point, it is very important to determine what that bonus depreciation is and whether the asset qualifies. So special depreciation allowance is 100%, aka bonus depreciation for 2022. Moving into the 2023, it's going to be 80% unless it changes, okay? Now, let's say there is a business that actually wants their financials per books look a lot like the tax return, because it could be something not cash intensive, let's say some kind of passive activity, but there's enough of assets to where they just want to have a good projection year to year to year, how much of depreciation they can take. And so what they can do is they can opt out of bonus depreciation. They can stipulate and say, well, looking at our books, even if we take regular depreciation, we are showing losses anyway. But what we need to know is, that we have these stable losses moving forward. So because let's say they have other businesses and they need to know how much of a loss they can take in each year because they need to stay cash positive for their other businesses or I don't know, other rental properties or something along the lines. So sometimes clients do want to opt out, okay, of bonus depreciation. The way it is done, it is going to be done on class life basis. So it's not, you can't just do the blanket opt out, okay, meaning the client just says, to you, I don't want bonus depreciation on anything. And then we elect that. There's specific disclosure that gets attached to the tax return that there is just a blanket opt out of bonus depreciation for that year. Okay. And by the way, special allowance, 179, both of these and special allowance, you guys are remembering by now that it's also called bonus depreciation. These are granted in the first year that the asset is placed in service, which, is kind of common sense because you get to depreciate bulk in the first year, or all if it's 100%, and then you just keep depreciating whatever little left over you have on the books for that asset. But you can also opt out by class life, and that's why class lives matter, okay? Because you need to be sure that, let's say, if it's a 5-year lived asset, they're grouped properly, or sometimes you need to assess which actual class life you want to opt out of to give the best portrayal of the business, because maybe, let's say if it's a restaurant, they go through, I don't know, for some reason, chairs too much. And so ideally chairs, if they go through them too much, let's say you could even classify them as a 3-year, even though it's not an option within the software, but you could. And so if you classify them as a 3-year property, then you can say that, hey, I'm opting out from a 3-year property because if they go out of service, we're going to write them off anyway. So in a way, you don't even need bonus depreciation because you just want to know historically, looking at year by year comparison of current depreciation schedule, how much of chairs you're losing for some reason. I don't know why with somebody, but maybe it's one of those places where people like to brawl. So by class life, you can also elect to opt out of bonus depreciation. Okay. This I would say you can skip while reading this altogether because you would be using general depreciating system. Okay, so in a way, you don't need to kind of drill down what the heck is ADS, but within the GDS, general depreciation system, what you're going to see is that it falls under maker's rules, okay? Under maker's rules. I would strongly suggest just to read through these. I'm not saying they're very, very packed, but according to makers, you would need to determine not just the class life, but based on when the property was placed in service, you would either depreciate it with the half-year conversion or mid-month or mid-quarter conversion. Sometimes in order to do that, you actually would need to run the mathematics of how much of the assets for the business were placed in service in certain quarter or in certain month or which date that was period. Good news is that the software most of the time does it, and when it doesn't, it's not material enough to where IRS would send a letter to the client. Okay, it will only matter for, I would say, cost segregation studies that would do. And then there's limits. Okay, so I would suggest read through chapter 4, but focus on makers. Read through chapter 5. It talks a little bit more about that listed property. Okay, and then of course business use requirements and whatnot. And let's look. Okay, so most of the time, one would have an option within the makers, okay, system, whether you can elect 200 double declining method, 150 declining method, or straight line depreciation. Okay. Now it will matter on when the asset was placed in service. So don't look at the ADS because that doesn't matter. We're going to always be referring to the GDS. So for convention, that is half year and mid-quarter, you'll see. Technically speaking, you can choose whatever you like, but when it comes to straight line, it's not always the most beneficial because straight line, it is what it is. It's technically speaking, you literally just take $7,000 if it's an asset and you take $1,000 each year. What 200 double declining method does is that you take, let's say, a third of an asset in the first year, because think of it this way. When the cars are being sold, once you took the car from the lot, boom, it plummeted in value right there. Okay, let's say if the car was 70K, you right away lost 10K just by taking it out from the lot once you purchased it. So most companies opt in for the double declining method. Okay, and it's available for half year and mid-quarter conversion for most of the class lives. Okay, for most of the class lives, except for longer lived assets like 15, 27.5, and 39. So now let's take a look at this guy. I'm not going to attempt to pronounce this, but what has happened was he has been depreciating the rental property over 27.5 years. When we look at when he placed it in service, it was after half of the year mark. So it was after 6/30, oh, let's say 12, okay, 2012. So 7/29 tells us right away that we need to use mid-month conversion. And because the class life is over 10 years, we must use straight line. Okay, we must use straight line. Now, when we look at his 1040, we're going to see naturally that he sold the property. And when we look at the capital gains, this is the way it's going to look. Gross sales price. So this is technically whatever, he sold the property for, whatever 1099-S would be issued for technically the contract sale price. Cost or other basis plus expense of sale. Well, let's look at it. We're going to see that we do have depreciation here. We're not going to be changing any of what has happened in the prior years because we did show that there was prior depreciation or amortization. Oh, one good point here is land is non-depreciable. Okay, so land is non-depreciable. Land can only be subject to depletion if there is some kind of minerals, or something like that that's actually being developed or excavated or explored in there. Washer and dryer, of course, we're going to see prior special depreciation allowance, aka bonus depreciation, was taken on that. So fully depreciated asset. Home improvements, he said that they were done in 2010. How is that possible? That's not possible. So, well, even if it was possible, that's absolutely wrong. Atabek, did you ask the client what this was about?
Yes, yes. I sent you, in WhatsApp email from admins. He sends these improvements were made in 2010. They bought this house in 2012, and admins asked, can we put these dates like this? And I didn't change.
Well, then they probably were included into here. So that really doesn't matter. These improvements were probably before he started, because this one says building and improvements. And this is the problem because these need to be separated out. We don't know what the heck this was, and right away we need to talk to the client. Because now it seems, what it seems like is that he's simply going through his records and inflating the basis of this property. Technically, whatever the property was worth or is worth to him. And this is absolutely wrong because we don't care when he did them. We care whether they happened once the rental was placed in service. And if they happened before, then their date placed in service cannot be later than the property, or earlier than the property itself. So this is absolutely incorrect. Right away, that gives you guys a red flag that I need to have a meeting with this client because this is bullshit.
Yeah.
Either buried in here, it's part of the 252,445, or it has not been shown on the depreciation schedule, period. And then we need to submit for catch-up depreciation or stipulate that these came about, in part of like expense of the sale in 2022 when he sold the property. That's when he realized that additional $12,000 were spent at some point, however, not really have been depreciated. So a red flag right away, and I need to meet with this client via Zoom and understand what is this about. Now, once you click on details, you will see that whenever you select how it's going to be depreciated, it'll give you, description of what it is. Okay. Improvements, well, that's absolutely incorrect because it's a rental property. It's buildings, so there's that. It's buildings and improvements, and just like we talked about, the name, if anything, should be what is the bulk of what that was. Improvements, unless it's complete rehab for the property or reconstruction of something. It's always going to be building. Is this spelled correctly? building. What's there?
Yeah, it seems correct.
Okay, whatever. Um, building and improvements. Okay. So long story short, buildings, and then we go from there. Prior depreciation, that's fine. Okay. We go into dispositions. So for the dispositions, you see how this one says we can dispose things in bulk. So date sold, disposed, he sold it on 4/29/2022. And right away we see a problem here. Where are the expenses? So we see that he sold it for the 430, and all that he spent on it is this 697. I don't believe it. There should be title charges, transfer fees, realtor fees, I don't know, cleaning the property fees, something along these lines. So definitely stuff is missing. Expenses of sale or exchange. This is not by any means complete. Do we have a final closing statement?
Yeah, I think yes. Give me a minute, I will send it. I just sent all 3 files with this real estate, connected real estate in the group.
Would you say, sir?
Yeah, I sent everything to the group. Everything connected with this real estate sale, 3 files.
No, it's just income and expenses for the property. So it's whatever he made on the rents, and those what the expenses were, like management fees. That's not the sale document. So do we have actual sale document for the property? Like a
Yeah,
final,
proper. Yeah. Just check. There is property sales statement. I sent this file. Yeah.
okay? Okay. So closing costs, you did pay 3,136. That's another expense. So what you would need to do, you would need to go through this, get all of the expenses that happened and put them in there, okay? So over here, you would add other expenses that happened at clothing, such as those $3,000 or whatever they were.
Mm-hmm.
Then few things are going to happen. There was this washer dryer, and we will notice that, of course, it has different class life. Okay, it's lived over 5 years, and when we look at this, it is part of the same disposition, which is in this case absolutely fine, but I will explain what the hack diagnostic says. So, depreciable asset number 3 has a depreciation recapture met at 1245, 1250, That differs from the bulk sale or the depreciation recapture. Okay. And so when we look at the bulk sale, we're going to look at disposition. So first of all, miscellaneous tab needs to be filled out, okay? And we need to mark that it's a complete disposition of passive activity. Absolutely must, otherwise, if they do have carry forward losses, these are not going to get freed up. And then if it's blank, it's 1245. If you want to override something, then you override to any of these. So, give me one second. So, technically speaking, a rental property, okay, is going to be 1250. Certain improvements can be part of actually 1245 recapture rules. I would say that since here everything was bulked up, we're going to call it 1250. Okay. We're going to go back to quick entry. And then since all of these, well, land, of course, is part of the building, it's going to be 1250 as well. We're going to override the heck out of it. Back to quick entry. We're going to override this. And for now, we will also override this, but then of course, client and I need to sort this group. We're going to click back to quick entry and refresh the forms. Okay. So now we're going to have depreciation allowed or allowable. This is now reflected perfectly, adjusted basis, and then total gain. We will see that rental real estate losses now got freed up, and we can take those. And this is going to be the new item here, okay? Now, capital gain is still showing through, and just to make sure that whatever was stuck is freed up, we're going to compare this, of course, to what we see on the 1040 within 33,335. Now, most of the time, what you guys are going to see for rental property, just remember, if it's a disposition, you must override everything to the 1250. If it's something related to just other business activities, let's say Schedule C, and you see that for the Schedule C, there is a car, a desk, a chair, all of that, and or machinery, and all of that went out, meaning got sold or scrapped, that's going to be 1245 property, okay? What it is, what I'm naming right now, these are sections in the IRS code that are used to determine how we're going to recapture or not depreciation. Now, in this case, when we look at 4797 at a detailed rundown, so to speak, we will see that the adjusted bases, okay, are higher than the gain. If the adjusted bases are higher than the gain, then we're not going to be recapturing depreciation, okay? It's a little bit more complex than that, but for now, we're going to stick to it. Otherwise, what you would see is it will show up here within the Schedule 1, okay? Within the Schedule 1, well, over here, other gains or losses attached Form 4797. That's exactly where it will show up, okay? So I think it's quite a bit to process, frankly speaking, okay? I think it's quite a bit to process, and I would truly like for you guys to go ahead and read the pub. So publication 946, go ahead, just kind of read through what we've talked about. It is available in different languages, okay? So at the back, if you guys want to read also in a different language.
Yeah, it's available in Russian, but I will prefer English anyway.
So all you do is you Google publication 946 Internal Revenue Service, okay? It's too bulk of a document for me to drop into WhatsApp because then it clusters my phone. So with that being said, in the software, it's actually quite intuitive. You type in whichever asset it is, whatever the name of it. I don't know, computer, bed, desk, chair. Then you tell it to which form it is going to go. To which form it is going to go. It's either going to be business, okay, Schedule C, or it's going to be a rental, Schedule E, or it's going to be, let's say, business use of home, if there were improvements done to overall house, or another thing you probably have seen that I work with clients where we take unreimbursed partner expenses. It's going to go to Schedule E partnership. Schedule E partnership. Very rarely, you will see anything else, especially since Form 2106 is, so to speak, no longer valid, available, and there's rare cases when we use it. It's better to determine whether you want to take mileage or actual expenses for the vehicles. We'll talk about more on that in the next session. But I would say Schedule C, Schedule E, and Schedule E partnership. Those are going to be your choices here. Then you're going to have number of activity, and this is literally description, okay? Let's say person has multiple businesses or multiple rental properties. You must put it towards the correct either business and or rental property, not and or, rather or rental property or partnership category. Well, it literally is what it is. You would determine, is it any type of automobiles or transportation equipment? Is it furniture and fixtures? Is it machinery and equipment? Is it buildings, improvements, land miscellaneous, or amortization? Okay, which we will talk about the intangibles in the next session. One thing I will say, if it's hard for you to determine which one is it, and especially between transportation equipment and machinery and equipment, for the first few times you're doing it, absolutely always text and chat, and let's take it case by case because it's not clear cut. Not clear cut. You could have a truck that the person uses for their construction business, if anything that helps in the business was actually permanently done to the truck. I don't know, specific suspension was put on the truck, or a very particular, I don't know, something was mounted on a truck to help person do the construction business that they're doing. It right away reclassifies it into machinery and equipment. But yet again, it must be material. Okay, must be material. So if in doubt, please text and let's take it case by case so you guys start developing, your kind of own opinion and you see how the process and the logic works on what type we're actually placing in service. Sometimes what's going to happen, you will need to override class wise, just like we talked about. If it's a restaurant, the software is not going to know that it's a restaurant, but all the furniture within the restaurant gets depreciated over 5 years, not 7 as a default here, okay? Date placed in service, well, we've spoken about that. It's when actually the asset started being used or put on the market to be used, okay? Cost or basis? Well, why does it say that? Because bases sometimes are higher, sometimes are lower than the cost, and we always must use the basis. Cost, it just kind of gives you almost like a cheat sheet. That's a starting point. If you just simply purchase something in the store and that's how much it was, that's great. But just like we talked about, was it installed? Was there any particular other components that needed to happen? And if the answer is yes, you will need to calculate the basis, okay? Just like when the rental property is placed in service. Was it bought? Were the improvements made to it already by the time that it was, that it went on the market? What has transpired, okay, with that property before it was even rentable? Then we refer not to the cost, but to the basis of the property, because the cost definitely is not going to be what we're going to be putting in here. Current section 179. Do not override this, okay? The software will calculate it. It will determine the best option between 179 and or bonus depreciation, and you can actually elect out of bonus. So special depreciation allowance, you can't say no. Otherwise, by default, if the class life is 15 years or less, it is going to go ahead and give it a bonus depreciation. Of course, prior, you fill out here, okay? This is when you take from, let's say, prior year tax return, you look at the current, meaning last year's, in that case, tax schedule, and you sum up whatever in that year current depreciation was with whatever on that tax return prior depreciation was stated, and then that's going to be your prior depreciation or amortization for the years, in this case 2022. Does that make sense?
Yeah, totally.
Okay. All right. So for today, we're going to call it for the fixed assets. By no means, just like I said, this is all encompassing. Please read through the publication. Prepare any questions you may have, and we're going to go over those.
Okay.
Okay. All right. Atabek, I think you can stop recording now.